Welcome back to the deep dive. Today we're plunging into a really fast-moving part of the energy world. Waaree Renewable Technologies Ltd, or Wario.
That's right. We've got their consolidated results for Q2 and the first half of fiscal year 26.
And these numbers, they're not just showing growth, are they? It feels more like, I don't know, acceleration, like hitting warp speed.
It really is. Wario, for those who might need a refresher, is the solar EPC arm that's engineering, procurement, construction for the bigger Waaree group.
Right.
And our goal today isn't just to read out the big figures. We want to get into how this company seems to be shifting gears. It looks like they're evolving,
Evolving how?
moving from maybe being just a contractor, project to project, towards something more like a long-term player, building a more stable base.
Okay, interesting. And the headline, I mean, you can't miss it in the source material. Highest ever quarterly revenue and profit after tax.
That's the big one, highest ever. Sets the stage, doesn't it?
It certainly does. So let's figure out how they actually pulled that off. Okay, section 1, financial velocity. Let's get into the Q2 numbers first, comparing this year to last year, FY26 versus FY25.
All right, so revenue from operations came in at 774.78 crores.
774 crores, and compared to last year.
That's a jump of 47.73% year over year. Pretty strong growth.
Okay, 47%, yeah, that's solid. But you mentioned the profit.
Ah, yes. The profit is where it gets really interesting. It shows efficiency, not just volume. The net profit, PAT, hit 116.34 crores.
And the growth on that.
That's the kicker. 117.40% growth compared to Q2 last year. Monumental.
Hold on, revenue up 47%, but profit up 117%. So profitability grew more than twice as fast as the top line.
Exactly.
How does that happen? Is it just like one or two really profitable projects hitting the books right now, or something more sustainable?
That's the critical question, isn't it?
Yep.
And the signs point towards efficiency. Look at EBITDA earnings before interest, taxes, depreciation, amortization. It's a good measure of core operational health.
Right. What did that do?
EBITDA for Q2 FY26 was Rs 157.94 crores. That's up 120.69% year over year. So similar massive growth there too.
Okay, so the core operations are really humming. Let's talk margins then. How much actual profit are they keeping from each rupee of revenue?
They're keeping a lot more. The EBITDA margin, it jumped from 13.65% last year to 20.39% this Q2.
Wow, from under 14% to over 20%? That's a huge leap in efficiency.
It is. And the net profit margin, the PET new margin, also expanded significantly. Went from 10.28% to 15.02%.
15% net margin in EPC. That feels quite high for construction-type work.
It does suggest something more is going on. Our source material hints that being part of the vertically integrated Waaree group is a major factor here.
Explain that link. How does being part of the group boost margins like that?
Well, think about it. The parent Waaree group is a major manufacturer of solar modules.
Okay.
So WareTL, the EPC arm, can likely source its main component, the solar panels, directly in-house. This could give them, better pricing, more stable supply, maybe locking in costs before the market goes up.
Ah, so they avoid some volatility that might hit competitors who have to buy panels on the open market.
Precisely. It lets them bid competitively, but still maintain better control over their own costs. That's likely a big driver behind that fantastic margin expansion.
That really puts the half-year numbers into perspective, too. For the first 6 months, H1 FY26, total revenue was, nearly 1,378 crores?
Yep, Rs 1,377.97 crores. That's up 81% year over year for the half.
81% growth. But the profit?
H1 net profit grew even faster, up 148%, hitting over 200 crores, or 202.73 crores to be exact.
Just incredible numbers, and the earnings per share reflects that.
Oh, definitely. Basic EPS for the half year shot up to 19.45 compared to just 7.85 in H1 last year.
So yeah, like you said earlier, they seem to be printing money faster than they're building the projects almost.
Well, those profits are great, but they reflect work already done or mostly done. To see where things are headed, we need to look at the engine for future growth.
Which in the EPC business means the order book, right? The contracts they've won but haven't built yet.
Exactly. That's your visibility into the next year or so.
So how's it looking? What's in the pipeline?
It looks very strong. Their unexecuted order book signed deals, waiting for execution, stands at 3.48 gigawatt peak.
3.48 gigawatt peak. Just to clarify for everyone listening, gigawatt peak, it's how you measure the maximum power solar farms can produce. And 3.48 gigawatt peak sounds substantial.
It's huge. And the company stated they plan to execute this backlog over the next 12-15 months.
Okay, so that gives them pretty clear line of sight on revenue well into fiscal 27.
Absolutely. and it's built on some big wins. They specifically mentioned winning large ground-mounted solar projects in Q2.
Like,
There was one massive one, 12,218 megawatt peak, and another 29.4 megawatt peak, both ground-mounted utility scale.
ground-mounted seems to be their focus. Is executing a huge 1.2 gigawatt project fundamentally different from doing, say, a bunch of smaller rooftop installations?
A completely different ballgame. Utility scale is very capital intensive, huge logistical challenges. But once you get the site and supply chain sorted, it's all about execution speed and efficiency at scale.
And the company's CFO commented on this, right? About their execution.
Yes, they emphasize that execution capability is driving the growth. And interestingly, they mentioned they're doing more than just installing panels now.
What else?
They're taking on integrated roles like building the substations and transmission lines needed to connect these large solar farms to the grid.
Ah, so offering a more complete package. More complexity, but presumably better value capture, better margins.
That would be the logical conclusion, yes.
Yes.
It adds value.
Okay, that's the confirmed order book. What about potential future work, the bidding pipeline?
Still looks massive. They report a bidding pipeline of over 27 gigawatts peak.
27 GWP, that's enormous. But how much faith can we put in a bidding pipeline number? Sometimes those are just, wish lists.
True. There's always uncertainty with pipeline figures. It doesn't mean they'll win all or even most of that. But the sheer size, 27 plus GWP, shows they're in the mix for almost every major solar tender happening in India.
And given the recent big wins, like that 1.2 GWP one.
Exactly. And factoring in their vertical integration advantage we talked about, you have to assume they're a serious contender, a tier 1 bidder, for a good chunk of that 27 GWP. It really paints a picture of the market opportunity they're chasing.
Okay, now this next part feels like a really significant shift. Section 3, strategic expansion. The board made some decisions back on October 10th, 2025.
Yes, this is where we see that evolution I mentioned earlier. They approved CapEx, capital expenditure, that signals a move beyond just being an EPC contractor.
What kind of move?
A move into owning assets themselves,
Yeah.
becoming an independent power producer or IPP. They approved spending for 3 new IPP solar plants that they will own and operate.
Right. Owning the power plants, not just building them for others.
Okay.
Let's get the details on those approvals.
Okay, so they approved 2 plants in Maharashtra. One 14 milliopi 10 MWAC plant in Purikavat, Akolkat, and another identical one in Hunter Mangalveda.
14 peak megawatts each. And the third.
A larger one in Rajasthan, Bikaner specifically. That one's approved for 37.5 milliopi PUP 25 MWAC.
Okay, so adding quite a bit of own capacity. Do we know how much they already had?
Yeah, the release mentioned they'd already developed 54.82 MWP. So with these new ones, plus others presumably in the works, they're setting up an additional 107.1 MWP in total owned assets.
So strategically, why do this? EPC seems incredibly profitable for them right now. We saw those Q2 numbers, EPC contracts brought in nearly 770 crores in revenue.
That's IRS, 76,919 lakhs, yes.
While the power sales segment from their existing IPP assets was tiny in comparison, only about 5.6 crores, or 558 lakhs. Why divert focus and capital to the lower margin, long payback power sales business?
It's a classic diversification and de-risking strategy as a business matures. Think of it like this. EPC is like building houses for sale.
Yeah.
You get big lump sums when you finish a project, but your income's lumpy, dependent on winning the next contract, and exposed to project risks.
Okay.
Becoming an IPP is like becoming a landlord who owns rental properties.
Yeah.
You invest capital up front, but then you get steady, predictable rent, in this case, revenue from selling electricity under long-term contracts, often 20-25 years.
Ah, so it's about stability, using the high but maybe volatile EPC profits to build a foundation of reliable long-term income.
Exactly. It smooths out the earnings, reduces reliance on constantly winning new bids. It makes the whole business less cyclical, more predictable in the long run. That's the strategic play.
Makes sense. And they also have the O&M business, right? Operations and maintenance.
Yes, that adds another layer of stability. They manage about 769 milliwatt of solar assets under O&M contracts that provide steady, recurring fee income, often for many years after the initial EPC work is done. It keeps them connected to the client and the asset.
So it's an integrated approach. Build, own some, and maintain others.
Precisely. Life cycle management.
Got it. And just briefly, there was also a governance item, something about stock options.
Yes, a small note, but relevant. approval to move forward with a postal ballot for shareholders to amend the employee stock option plan from 2022. Just shows internal housekeeping keeping pace with the business growth.
Okay, let's zoom out a bit. Section 4, connecting this all to the bigger picture in India.
Absolutely essential context. You can't really understand Airtel's success without looking at the massive energy transition happening across India. They're riding a huge wave.
The CFO commentary linked their performance directly to these national goals, didn't they?
Yes, very clearly. They pointed out that India's total installed renewable energy capacity hit 256.1 gigabW as of September 2025.
256 gigawatts. And the national target for 2030 is?
500 gigawatts. So India is already halfway there. It's an incredibly ambitious target, creating enormous demand.
And solar is a huge part of that 256 gigawatts.
The biggest part. Solar energy alone accounts for 127.33 gigawatts of that installed capacity.
Yeah.
So Airtel is operating right in the sweet spot of national policy and investment. Massive structural tailwinds.
And we keep coming back to this point, but it seems crucial. Waaree isn't just a standalone builder. They're part of the wider Waaree Group ecosystem.
Critical advantage. As we said, the group makes modules. But they're also involved in battery energy storage systems, BSS, and even exploring green hydrogen through electrolyzer manufacturing.
So when bigger, more complex projects come up for tender,
They're positioned perfectly. If a utility wants not just a solar farm, but also a large battery system attached to manage the intermittent power, the Waaree Group, through Waaree, can potentially offer an integrated in-house solution.
that must give them an edge over firms that only do EPC.
A significant edge, especially for large, complex tenders. They can manage more of the scope, potentially more efficiently.
And looking ahead, their strategy seems aligned with where the market is going next, right? Beyond just solar panels.
Yes, they've explicitly stated they're expanding into BESS and also data centers.
Data centers, interesting angle. Huge power consumers.
Exactly. And critically, they mentioned government support for energy storage, like the VGF scheme viability gap funding.
How does that help?
VGF basically subsidizes the upfront cost of building large battery storage projects, making them financially viable much sooner than they might be otherwise. So government policy is actively encouraging the exact areas Waaree is targeting.
So BSS helps solve the sun doesn't always shine problem for solar, and data centers represent massive new electricity demand, often looking for green power sources. Seems smart.
It's definitely targeting the next frontiers of the energy transition and digital infrastructure growth. So wrapping things up, Waaree record results in Q2 and H1 FY26 weren't just a fluke. It feels like a confluence of factors.
Okay, summarize the key drivers for us.
I'd say three things stand out. One, strong execution speed, likely amplified by that vertical integration with the parent group. Two, a massive order book, giving them really good visibility for the next year plus.
Right.
And three, that strategic decision to invest their EPC profits into building their own IPP assets, aiming for long-term, stable revenue streams. It's a company really shifting its strategy right now.
Definitely sounds like a transformation in progress. So here's the final thought, something for you, the listener, to consider. Their core business, their DNA, is EPC fast-paced, project-focused, requires intense management.
Very demanding, yes.
They ended the first half with about 68 crores in cash. Now they're stating this clear intention to push into really capital-heavy, technologically complex new areas like battery energy storage and data centers.
Both require significant investment and different expertise.
So the question is, can Waaree maintain that sharp execution focus and speed in their core solar EPC business, while at the same time successfully deploying capital and management bandwidth to build these entirely new complex businesses? Can they do both well, simultaneously?
That's the tightrope they have to walk over the next year or two. Balancing that core engine with these ambitious new ventures, that's the key strategic challenge ahead for them.
Definitely something to watch. Thanks for diving deep with us today.
My pleasure.
We'll catch you on the next one.